in now. Okay, so everything looks to be working. I actually put the right date on the things today, which is great. Always a challenge. But today is February 11th, 2025, and this is the $1 Trillion Show. With Tech Show. I'm your host, Neal. We've got Serena and Fatma on the line.
Hello.
Serena is our ops manager. Fatma's our admin extraordinaire. Um, Fatma has the unenviable job of reading my email. So anybody who sends stuff in, it goes to her first, and then she says, "Hey, there's this thing," because I get, I don't know, too much email, and a lot of it's just like software stuff. But Fatma reads each and every one, and then we have daily meetings on what we need to go through. But that's all behind the scenes stuff you don't probably need. So let's dive into the $1 Trillion Show. And what do I mean when I say $1 trillion? Well, what I mean is that that's the mission. It's to save $1 trillion. Save Americans $1 trillion in taxes. So Elon's doing his thing to save $2 trillion a year, at least by the end of the Trump term. And yeah, I'm on board with that. And I want to save Americans an extra $1 trillion because the spending is one part, but the raising is the other part. So government raises money through taxes and fees and other things, but mostly taxes. And then they spend it. So they're trying to get the spending under control, which I agree with the mission. I'm skeptical as to how effective it's going to be, but if we can cut off the flow in the first place, then that kind of takes care of itself to a certain degree. So that's the mission. And then how we do that? Well, we're going to scale tax saving strategies through technology because obviously, we're a tax advisory firm and we help small business owners and independent contractors and just regular old people save tons of money on their taxes doing, client work. But there's a limit to that. We're not going to be able to have, a trillion, or 10 million customers or clients. So the only way to get to this $1 trillion number is through technology and sharing tax saving strategies on the internet, essentially. And so that's part of what we do here on these calls. We've got courses, we've got tools, we've got workshops, all kinds of stuff in order to get that information out there so that people can put the strategies into place in their own lives so they can contribute to our $1 trillion that we're trying to save. So that's the how. One of the who. This is me. If you're not familiar, I got into the whole tax world because I owed the IRS over $1.3 million, and I got real nasty letters about it. And over a period of years, I fixed my own problems and ended up learning the tax strategy world from a former Wall Street tax attorney. So that's how I got into this whole thing, and that was over 15 years ago at this point. And since then, I've worked on over 50,000 tax returns and saved clients millions of dollars every year. And that's kind of what we do. So if that sounds interesting, stick around because we're going to talk about some real stuff today. Now, the what starter course. This is a course that we have. The most recent version is actually going online yesterday. Technically, we haven't promoted it yet, but it is there. And basically, the starter course is for people who are new to business and want to get started in the right way. So it goes through, how to set up your LLC, how to talk to the Secretary of State, how to get a tax ID number, how to set up bank accounts, how to implement basic tax strategies. So, that first money that you're making is as tax efficient as possible. And then, towards the end of the course, it goes into, growth and management and all that kind of stuff, and things you need to do in order to scale. So that is one of the things that we have available, and we'll get into how all of that works later on. Now, normally, we just do questions and answers at this point, and because I have the answer to every tax question. Serena knows the answer. What's the answer to every tax question?
It depends.
It depends, because it does. It depends on fact and circumstance. So we will get into questions if we have time today, but there are a couple of other things that I wanted to hit on first because we had some news last week on, I think it was Friday. So let me share this. Let me go to here. Share sound. Normally I don't share sound, but we're going to do that this time because We had this announcement back on, what was it, 6th, so 5 days ago. And here, I'm just going to play this. It's only 41 seconds.
So these are the tax priorities of the Trump administration that the president has laid out for members in that meeting today. No tax on tips, which is obviously a very public campaign promise that the president made. No tax on seniors' Social Security. No tax on overtime pay. Renewing President Trump's 2017 middle-class tax cuts. Again, these are the president's priorities. Adjusting the SALT cap, eliminate all the special tax breaks for billionaire sports team owners, close the carried interest tax deduction loophole, tax cuts for Made in America products. This will be the largest tax cut in history for middle-class working Americans. The president is committed to working with Congress to get this done. So these are...
All right, so that was the announcement from this blonde lady. I think she's the new press secretary. I'm not actually sure. But basically, this is the outline of the Trump tax proposal for this session of Congress. Now, Mike Johnson, Speaker of the House, has said he wants a tax bill done by April. So I just wanted to kind of run through these different items and talk about each one and sort of a little bit about the framing and what this might mean. Now, obviously, all of this depends on legislation. So this is Trump putting out his position, and this is the starting point for, the horse trading that goes on inside Congress. But, let's just take them one by one. So no tax on tips. That's number one. And this was a campaign promise from, especially in Nevada, where, there's a lot of people who work in casinos and things like that. And, they make a lot of tips as far as a percentage of their income. So there actually is a bill already in Congress called the No Tax on Tips Act. And basically, the way this bill is structured is that it creates a new below-the-line deduction. And below the line means after adjusted gross income. So let's say you're a waiter. If you work at a high-end place, maybe you make 80 grand and 50 of that is tips. I've seen that kind of thing, many times. And so your W-2 would still say $80,000, and there would be some kind of information field specifying how much was tips, and then that would go into your income along with whatever else is part of your income. Your adjusted gross income would be calculated, and then the tips would be deductible up to, according to this version, up to $25,000. So immediately you run into an issue. When you have deductible things like your mortgage interest or like your charitable contributions, there's a standard deduction and then there are itemized deductions. You calculate all your itemized deductions, and if it's less than the standard for your filing status, then you just go with standard. And then if it's more than the standard deduction, you go with itemized. So it sounds simple enough. However, there's a dead weight loss issue. So if you're in 2025, if you're a married filing joint filer, your standard deduction is $30,000. So if you have $35,000 worth of itemized deductions, really you're only getting an extra benefit from that last five. Okay. So if you have $25,000 worth of tips, and that puts you over into, let's say, $32,000 worth of itemized deductions, great, but you're really only getting a discount on $2,000. So there's that issue. To partially counteract that, there's what this bill is suggesting is we create a separate below the line deduction where you'll have your standard deduction or itemized deduction of however much that is, and then below that you'll have another deduction of your tips up to, again, according to this version, $25,000. So if that ends up happening, then you're able to separate out that dead weight loss and really get the maximum effect from that tips deduction. So will this survive? Will this make it into the whole plan? We don't know. But the same kind of mechanism was done during COVID for charity. So I don't know if everybody remembers this, but there was a special line for charitable contributions up to $300, even if you didn't itemize during those years. So you had your standard deduction of like 12.6 if you were single, and then an extra $300 worth of deductions for charitable contributions, and then that reduced your taxable income, and then your tax was assessed after that. So this is the same kind of mechanism that they're talking about. There are some nuances though, in that if you go into the definitions, is that, let's see, exclusion for certain employees. Such term shall not include any amount received by an individual in the course of employment by an employer if such individual had for the preceding taxable year compensation, in the excess under the amount of Section 414. Published list of occupations traditionally receiving tips. So no later than 90 days after the date of the enactment of this act, the Secretary of the Treasury shall publish a list of occupations. So immediately you start having questions. It's like, well, okay, if taxes are exempt or deductible or whatever the case ends up being, it's like, how about I just make a third of my salary tips? Why not? Right. And so to head that off at the pass, they're saying, okay, this is restricted to a list of occupations traditionally receiving tips. And so, they're trying to say, well, you gotta match an occupation. But there's a problem already. So the only place your occupation is listed on your tax return is on the occupation line on page 2 of your 1040. So that's where you sign, date, and have occupation. So does that mean your occupation has to match one of these things? So if you're a waiter or a bartender or casino dealer or whatever, is that the thing that has to be on that line? Because I've seen plenty of people put in just kind of vague general things, clerk, employee, all kinds of things like that. And then what happens if that's the case? What happens if you have tips in a traditionally tipped job like a bartender, but that's not your main job. That's a side job. Okay, so 9 to 5, you go to work and do some office work, and then on the weekends you bartend at this place. So if that's the case, your occupation is going to be whatever you do at the office. It's not going to be bartender, or maybe it's going to be office worker / bartender, or So immediately you start to see some of the challenges with classifying these things. Is your occupation then going to have to be listed on your W-2 so that they know that these tips are actually subject to tip deductions? So it's unclear how this kind of thing would be created and enforced and followed up on. To make sure that things are reported in line with this pending legislation. So we're only on the first item and already things are complicated, right? As far as putting the rubber to the road and figuring out how this is actually going to work. All right, so that's the no tax on tips part. No tax on Social Security for seniors. So it's interesting that they're specifying for seniors. Most people who get Social Security are seniors because it's it's OASDI, Old Age Survivors Disability Income. So there's the 3 basic groups. There's old age, which is most of Social Security recipients. There's survivors, which is minor children who have a parent pass. They get Social Security payments up to the time they're 18. And disability is, well, disability. If you pay in for a certain amount of time and then you become disabled, you can get Social Security disability. So they're only talking about the seniors here. So the survivors and the disability income, you're not on the list. And again, there's a fact-checking element to this of like, well, how do you verify that this is old age Social Security versus the other types? Because on the forms, that's not evident at all. You can probably figure it out based on age, but so that's probably one of the simpler adjustments. So the no tax on Social Security for seniors, I'm actually in favor of this one for sure. Well, I'm in favor of all tax cuts. Let's just say that. But this one makes the most sense to me because the Social Security system was not created as a pay your own benefit. It's not like you invest in Social Security and then you get a return of that Social Security when you retire. No, you pay into the fund pays out to current recipients, and that's it. Okay, there's no savings account, there's no anything, there's no lockbox with your name on it. That's all just political fiction. You're just paying into the fund pays out, and then the end. Okay, so if you're I'm 45, and when I turn 68 or whatever the full retirement age is, whoever's paying in then is going to be paying me. And so even with that said, though, there is a sense in which it seems unfair, right? Because if I paid in on my wages my whole working life, and those other people were basically getting my money, it's like, why am I then turning around and paying taxes on money that I'm receiving at the other end of the system? Because it's like they get you coming and going, right? So there's an element of fairness that I think we could or should eliminate taxes on the Social Security for I would say for everybody, but for seniors, sure. The big criticism that Trump has gotten on this issue is that well, if you reduce the tax on Social Security benefits, then that money is not coming back to Social Security, and that's going to accelerate the rate at which Social Security goes broke. And that is true. However, I ran the numbers and I looked at the actual budgets and I looked at the population forecast and all this kind of stuff. And it's like 6 months difference. So instead of going broke in December of 2033, it'll go broke in June of 2023. It's like, or 2033. So it's like, okay, yeah, you're true, but not significant and doesn't really make that much of a difference. So, might as well do it. And people, of course, ask, is like, well, what happens after Social Security goes broke? Well, what happens if nothing else changes is your benefits go down. Because historically, from 1930, was it 33, 32, 36? Sometime in the 1930s, Social Security was implemented. And people have paid in taxes. And for a long time, Social Security was running a net surplus, meaning that more taxes were coming in than benefits were being paid out. And so Congress took that money and spent it on other stuff and gave the Social Security Administration a bond, basically a treasury bond. And in, I can't remember the year off the top of my head, 15 years ago, let's say, Social Security taxes coming in were no longer enough to pay the benefits going out. So, the Social Security started cashing in those bonds to make up the difference. And so that has continued to today. And in about 8 years, according to current projections, and they update the projections every year, but in about 8 years, those bonds will be exhausted. And now the money coming in from Social Security taxes of various kinds will not be enough to meet the outgoing payments, which means the outgoing payments are going to be cut until they meet the incoming taxes. So that's what's going on currently. That might be changed with legislation and who knows, but that's the current situation. So if we, basically $50 billion worth of revenue to Social Security each year comes from the taxes on people receiving benefits. So that's the number that we're talking about is reducing that 50 billion to, pretty much zero, because most disability Social Security recipients and most survivor Social Security recipients don't pay taxes because their income is not high enough to trigger any of the Social Security to be taxable in, I would say, the vast majority of cases. So the people paying that 50 billion are the seniors. So, you can take that for what it's worth. So that is the no tax on Social Security. I'm in favor, just from a basic fairness perspective. No tax on overtime. So this gets tricky. So what does it mean to get overtime, right? And if you look up the labor board, the requirement is that if you are non-exempt and you work at least 40 hours or over 40 hours, then your employer is required to pay you overtime, time and a half. So the strategy mind of mine immediately goes to work. Is like, well, okay, so we got two issues. So one is exempt versus non-exempt. So if you're non-exempt, you're considered hourly, right? If you're exempt, then you're in a management position of some kind or another. Historically, exempt meant that you were a higher status. And so a lot of people took it as a badge of honor that they were not being paid hourly, that they were paid salary, right? And so this might change some of that. It's like, do I really want to be management, quote unquote? How many managers are really doing manager work, subject to debate. And then the overtime part, it's like, well, the way the law is written is that if it's over 40 hours, you have to pay overtime. There is no regulation on paying overtime under 40 hours. So could it be an employment benefit if you start paying overtime at 30? I don't know, maybe. Maybe my job only takes 10 hours a week and everything after that is overtime. So anytime you're fiddling like this, you invite these kinds of questions, and you can be 100% sure that there are going to be people out there like me who are going to, look at the regulations, look at the legislation, and figure out what is the most advantaged way to play this, right? Because, that's what we do, right? Nobody wants, well, not nobody. all of our clients at least don't want to pay taxes, but they want to do it in a legal and ethical way. So if whatever the rules are, we will follow the rules in the most effective way, right? So the issue with carve outs and this used to be called like voodoo economics, where you would assess special taxes on this, and they would sunrise and sunset. It's generally a bad idea. What is better is just to have a wholesale system that works across the board, but then you can raise and lower the total, so that you spread the base out as far as possible. And there's lots of economic work on why that's more advantageous as opposed to these special carve outs, because it reduces the distortions in the economy from people trying to take advantage of these special carve outs. So no tax on overtime. We'll see how that works, and then we'll have to work on the reporting element of like how much of that is overtime and how much is regular. It could be done, but not everybody's tracking that in the right ways, and so people have to upgrade systems, and so compliance becomes more complicated because the reporting will have to be more complicated as we have these different kinds of issues. Renew Trump tax cuts, and while she was talking, she was saying the middle class tax cuts, and so not exactly clear what that is. One thing I hope to see continue is the qualified business income deduction that was created under Tax Cut and Jobs Act. So that's the thing where if you have a pass-through income from a Schedule C, from an S corporation, from a partnership, you could get up to 20% of a break on that income for tax purposes. So if you have $100,000 worth of profit, maybe you only pay tax on 80 of it. And there's criteria and all this kind of stuff as far as wages and income and all this kind of stuff. So that's one of the Trump tax cuts that I hope it gets included. The change from smaller standard deduction plus exemptions to just larger standard deduction, that's probably in this cut, or this make Trump renew the Trump tax cuts issue. So if anybody remembers way back to 2016, you used to file taxes with exemptions based on the number of people in your tax household. So if you were a family of four, you would have an exemption of four, and 4 times $2,000 was $8,000. And then on top of that, you had a standard deduction. So they got rid of the exemptions and they just made the standard deduction bigger, which for smaller families worked out better. For larger families worked out worse. And so it depends on where you fall on that divide as far as whether that helped you or hurt you. So I anticipate that will also continue under this renewal, assuming all this passes, right? But also, as the renewal, a lot of things were eliminated from individuals. So things like unreimbursed employee expenses. So we have this conversation multiple times a month with clients. It says, well, I have this job, but I also work from home. Do I get to deduct home office? It's like, well, are you working as an employee? Yes. Then you get nothing. Okay. So this was one of the changes that was eliminated. Moving expenses used to be deductible federally as long as you moved at least 50 miles and for work purposes. That got stricken. So a bunch of little things like that were removed from the individual side of the tax planning, in order to pay for, quote unquote, the other tax cuts that were created through the business deductions and things like that. The other thing with the renewal of the Trump tax cuts is probably going to be bonus depreciation. So when the Tax Cut and Jobs Act was originally passed, we got like 7 years of 100% bonus depreciation, which was amazing. So if you buy an asset, a capital asset that has to be depreciated over several years, normally you take a percentage. So if it's a 5-year asset, you take 20% in year 1, 20% in year 2, and so on until you use up the expense. And that means you're out the cash, but you're not getting the full benefit from the deduction when you spend the cash. So bonus depreciation fixes that though. But under 100% bonus depreciation, you bought the asset. If it's a 5-year asset, a 10-year asset, whatever, you still got to write off the whole thing in year 1. So the idea here was to incentivize the investment into infrastructure and equipment and all these kinds of things for companies in America. Because if you get the full tax break, up front, then time value of money, it's better off taking that now as opposed to later. So that's probably going to be, coming back with this renewal. So there's a whole lot of other provisions that were created as part of the Trump tax cuts. Just by saying renewing the middle class, whatever, it's not clear. But those are some elements that I expect will be part of this tax bill that I'm talking here. Included in that is the SALT cap. So this is one of those deductions that wasn't eliminated, but it was reduced. So in the old days, if you lived in a state where you had high taxes, then you were able to deduct those as part of your itemized deductions. So, if you're a high income earner, so we've got people in like New York who earn $400,000 on payroll, and so their income tax, their state and local income tax is enormous, right? Like tens of thousands of dollars, plus property taxes. So whatever goes in that chunk of your itemized deductions has been limited to $10,000 ever since 2017. And some states have implemented workarounds if you run your own company with pass-through tax payments and things like that. But still, it's a major, major problem. And people in these high tax areas have been very upset about it for the last 10 years, rightfully so. And so here they're saying adjusting the SALT cap. So SALT is state and local tax. So adjusting does not mean eliminating. Okay, so what we're likely to see here is the cap going from 10,000 to some higher number. Higher is better, incorporates more people, but eliminating the cap altogether so you could fully deduct it like we used to be able to would be better. But we'll see what that number comes in as. That is going to be a major point of negotiation because most of those high tax states are Democrat states, right? That's why the original Tax Cut and Jobs Act was like a political masterpiece because it punished the people who were voting Democrat, and the Republicans were passing the legislation with no Democrat support at all. And so it was, basically punishing Democrats to pay for the benefits that go to, the Republican base. So, you got to hand it to them. Politically, that was amazing. For the people on the receiving end of that, obviously huge punishment. So they're trying to adjust that punishment, but we'll see how that number shakes out over the next month or two or three. The next two, the ending tax breaks for billionaire sports team owners and closing the carried interest loophole. These are popular issues, I guess, or populist issues, where you could say, hey, let's not give those fat cats special treatment. But in terms of actual revenue, these are like non-issues, right? It's like a rounding error on tax revenue. So basically, the carried interest loophole is an interesting one. It basically, if you are a hedge fund operator, then the profits that you make get capital gains treatment instead of ordinary income treatment. Okay, debatable as to the historical origin of that and like why it's important or not, but it doesn't especially matter for everyday people, and it's not going to change the federal budget at all. I think tax breaks for billionaire sports team owners, same kind of thing. Did you know that the NFL is a nonprofit organization? It's wild, people spending thousands of dollars on Super Bowl tickets and TV contracts worth billions. But yeah, it's a nonprofit, sure. We'll see how that all gets shaken out. But again, not a significant factor in taxes or anything like that. And then the last one, tax cuts for Made in America projects. That's kind of a vague statement, and we'll see if it's probably going to be some sort of manufacturing credit, where if you invest in tools and equipment and people and that kind of thing, you'll get some tax breaks there. I imagine it will be somewhat similar to the R&D credit or the credit for increasing research activities and the work opportunity credit, but we'll see. Obviously, the focus here is to increase American manufacturing as opposed to foreign manufacturing, and this kind of goes hand in hand with the whole tariff argument. So if there are higher tariffs, that's going to increase prices of everything that's imported, and ideally you would offset that by more domestic products that don't have tariffs because they're domestic. So we'll see how that all shakes out. But that's the Trump announcement from last week, and my expectations on how that's all going to shake out. So as we're recording this, it's February 11th, and tax day is April 15th. So the big thing is for the current tax filing season is the SALT cap. And there's a very strong possibility if they get this passed in before April 15th that the SALT cap adjustment will be retroactive to 2024. So you got to keep that in mind. I was talking to a client yesterday, and he was asking, it's like, well, should we wait to file? It's like, yeah, maybe in your case it's like $2,000 worth of difference. I don't know if that's worth waiting because he was getting a nice refund. So, so option one is you file. If there's a change and it's retroactive, then you amend later. Option two is you just wait and then file with whatever legislation is passed at that later date. So, it's every situation is going to be different because it depends. And, you got to make your own decisions there. Now, the other element that when it comes to retroactive that might be important is the bonus depreciation. So there was a bill in Congress last year that passed the House, did not pass the Senate. And, it had the bonus depreciation retroactive to 2022. So, the way the bonus worked, it was 100, 100, 100, 100, 100, and then 80, 60, 40. And so they were going to fix the 80, 60, 40 back to 100 retroactively. So, if that gets included, then, that is potentially, really powerful for people who have already filed taxes for those 22, 23, and then now 24 years to include those assets in a more depreciated state. And then it's going to carry forward into other years. So like if you fix 2022, that's going to fix your carry forward into 23. So then you got to fix 23, and that's going to fix your carry forward to 24. So it's going to be a lot of work, but that is potentially on the table because, again, all these big bills, a lot of times they're pieces of different things that just get put together. So the language that's already out there has a very high chance of making it into the new bill that gets passed altogether. All right, so that is the Trump announcement from last week. And we got Bananas asking, I'm waiting to hear that Doge found enough wasteful spending to cut taxes down to very low or none at all. Yeah, so that'd be nice, but it's not happening. So, there's all this news over the last week and a half about Doge finding, these payments that are going to this insane thing, these payments that are going to that insane thing, fraudulent claims on people who are 150 years old getting Social Security. Even if all that's true, it still doesn't work. The federal spending is so large that even if you cut out all that stuff, all the discretionary, if you cut out 15% of Social Security, if you cut out 20% of Medicare, it's still a deficit compared to the taxes raised. So it's just not reality that the Doge project is going to be able to eliminate the need for tax. And then then you have the other people saying, well, we can replace it with tariffs. No, you can't. There's not enough imports in order for it to raise that level of tariff income for the government, because the tax system raised $4.3 trillion for the last fiscal year for the federal government. Now they spent way more than that, yes, but the 4.3 trillion is critical because the excess is paid by borrowing, which creates inflation. And we can get into a whole economic argument as to how that all works, but for now, just take my word for it. That excess borrowing from the federal government has pernicious effects and has, there's Cantillon effects, there's crowding out effects, there's all kinds of things. But effectively, the debt gets monetized through the Federal Reserve System and increases the money in the system, which decreases the purchasing power of the dollars that you hold. So inflation, okay? So if we can shrink the deficit down to zero, that'd be great. Doge might be able to do that, maybe. But it's not going to cut it down to where the federal government doesn't need tax money anymore. That's just not possible given the current system. Like if we got rid of Medicare and got rid of Social Security, okay, now we can have that conversation, but that's not politically going to happen. Okay, so I'm as much in favor of Doge as I am. Yeah, I got to be realistic about the possibilities. All right, so I just spent the last 30 minutes talking about Trump tax cuts. Serena, what do we have for actual questions this week that we can get to? You're muted, by the way, like a boomer.
Sorry about that. So Neil, the audience wants to know, with President Trump's proposed tax changes still pending, what other changes would you suggest if you had the opportunity?
Oh, that's a good question. Uh, what would I do? Like if I could wave a magic wand. Well, okay, so are we talking politically realistic or wave a magic wand kind of thing?
Uh, Last one, wave the magic wand.
Okay, wave magic wand. All right. So what I think the real tax system should be is a net income tax. So what we have now is a quasi gross income tax. So like, when you file your tax return, you have your sources of income, you have your W-2, you have interest, you have dividends, you have stock sales, you have profits from businesses, you have retirement income, all these different things. And they'll get added up and they create your adjusted gross income. So it's not pure gross income because it's adjusted, but it's close, right? And then you have a couple allowed deductions, like the standard deduction or the qualified business income deduction, but then that's it. Okay, so it's adjusted gross income, a couple allowed deductions, and then taxable income. And then your tax is calculated on that taxable income number. And then maybe you get extra things on the back end, like if you have kids and you get credits for those, maybe. Just kind of depends on the numbers. So what I would rather see is have everybody operate like a business. So people say it's so unfair that businesses can write off all this stuff, and I agree that it is unfair because the rules are different. So a business brings in money, spends money, and pays tax on the remainder, whereas a person brings in money, pays taxes, and spends the remainder. So I would rather have individuals and people taxed like businesses so that they bring in money, they spend whatever, and they're taxed on the remainder. And effectively, that would be almost like a mark-to-market account, where if you're like a professional stock trader, you don't pay tax on every individual stock trade. You pay tax on the beginning balance of your account versus the ending balance of your account. That's the mark-to-market adjustments. So that's what I would rather see because I talk to people all the time. It says, okay, your W-2 is, I don't know, $85,000. Last year was 78. You made $8,000 more, right? Or $7,000 more. And every single time, the response is exactly the same. They said, really? Where did it go? And because you spent it, right? Fundamentally. So part of it was taxed because your payroll taxes went up and your income taxes went up. But part of it you just spent because the cost of living went up, right? And as you have more money in your pocket, you're more likely to spend it, right? So the net effect is that people might be earning more and more and more, basically due to inflation, but they're not saving anymore. You can look at all kinds of charts about net savings rates. You can look at studies come out regularly saying X percentage of Americans can't afford a surprise bill of $400 or $1,000 or whatever it is. So what if we're going to have a tax system? I think the the fairest way to do it is on a net income basis so that everybody operates like a business. So you bring in money, you spend money, and then you're taxed on the remainder. And then you can argue about what that tax rate should be, right? Because one thing to keep in mind is like, you know, granted, we don't have a purely closed economy, so money does leave. But fundamentally, if you're spending money, it's ending up in someone else's pocket somewhere, right? So, um, the net tax should accrue to whoever it accrues to, but the base for the tax assessment should be constant. Okay, because if you deduct it, somebody else has it as income. And that would actually spur economic activity because it would increase the velocity of money. So you're incentivized by whatever tax rate to spend that money, rather than saving it, which will get more people buying stuff effectively. Um, Now, the caveat with that is that it's always a percentage basis, and it's the same discussion that we have with people towards the end of the year. They say, "Well, should I buy a car? Should I buy a boat? Should I buy a computer? Should I buy this? Should I buy that?" Like, okay, if you buy a business asset and you're operating as a business, then you can deduct that business expense, and subject to all the different things that it's subject to, limits and depreciation and all this kind of stuff. But you're only ever getting back a percentage of the amount you spend in tax savings, because taxes are never more than 100%. They're going to be 37%, 21%, whatever. So you're still spending the money, right? So even in a net tax situation, you don't want to spend money on things that you're not going to use and buy anyways, because the math doesn't work. It's not worth spending $1 to save 30 cents, right? If you weren't going to spend that dollar anyways. So that's the only caveat with that. But yeah, if I could wave a magic wand, net income tax on everybody, not an adjusted gross income tax.
Love it. Like that idea. So looks like we're jumping into a real estate question, Neal.
Okay.
Airbnb question, that is.
Yep.
So how do I report Airbnb or short-term rental income on my taxes?
Yeah. So there's actually a little bit of a gray area on this. So there's two possible answers. One is Schedule C and one is Schedule E, and it depends on whether it actually ends up being subject to self-employment tax or not. Now, in most cases, it actually doesn't matter, because one of the things about Airbnb is that if the rental activity has an average stay of less than 7 days, then it's considered active as opposed to passive, and there's all different kinds of implications for that tax-wise. In fact, I put out a course last week or the week before called the Non-Passive Real Estate Investor, which is a free course that you can find in the Explorers group if you're not already in there. And it goes into this issue. But where do you report it is, like I said, you have the two choices. In most cases, it doesn't really have an impact because most rental real estate operates at a loss for tax purposes because of depreciation. So even if you're making money on a cash basis, you're probably losing money on a tax basis because of you're writing off a portion of the property over time. Now, as a short-term rental that's active and instead of passive, go to the course and you can find the details about all this, but that allows you to be more aggressive about depreciation, and you can take more expenses in the early years as opposed to waiting 27 and a half years to capture all that. And that gets into cost segregation and things like that. So so most people will just do it on Schedule E. Some people will do it on Schedule C. The only twist with the Schedule C is that if you have a loss there, that can impact your Social Security earnings later on in life. So just be aware of that issue. I've had a couple people be surprised by that when they look at their earnings record with the Social Security Administration. By the way, everybody should have an account at ssa.gov just to have it, so that you can look up your earnings history online and not wait for the letter that they send you once every 5 years or whatever it is. And you can queue into issues like that. So I remember I was talking to one client, and this was unrelated to real estate, but at the same Schedule C issue. He was looking at his earnings, and it's like 30,000, 50,000, 40,000, 0, 20,000, 80,000, and he was like, I earned money this year, so why does it say 0? So we looked up his tax return, and we hadn't done it, but he had a copy. And I said, oh, well, yeah, your W-2 was $40,000 that year, but your Schedule C was minus 60. So that put you at minus 20. And because the Schedule C has self-employment impacts, that eliminated your Social Security contribution, even though you didn't get the money back, right? Because again, it's not a fund for you, it's fund going into paying other people. So, there's that nuance to be aware of. And typically we will run them on Schedule E along with other rental properties. If you're doing all the management yourself, there is an argument to be made to do it on Schedule C anyways, but case by case basis. So yeah,
that was going to be my next question, Neal. What's the best way to kind of report rental income? Is it Schedule C or E? But you already answered that. So unless you want to elaborate even more.
Yeah, so if it's a long-term rental, it's always Schedule E. If it's short-term or active, you can have that discussion as C versus E.
So it depends.
It depends. Yeah.
Alrighty, understood. Looks like we have another real estate question. So a client wants to know, how can I use a self-directed IRA to invest in real estate tax-free?
Yeah. So this is a strategy you'll see promoted a lot amongst real estate guru types, and it works. So basically, if you have money in a self-directed IRA, then you can direct it. You can make your own choices. So IRAs have very, very few limits or things that are not allowed. Basically, it's collectibles. So you can't invest in artwork. You can't invest in rugs, stuff like that. There's a list on the IRS website, which is fairly short. There's like 10 things on it. Everything else is allowed. Okay. So the way people do it for real estate is that they will have, or I'll say the best way to do it, they will have an LLC that is owned 100% by the IRA. And the reason to do it this way is because if you try to buy a property just in the IRA's name, the closing attorneys and the title companies, they freak out. But if you have an LLC, they understand how that works and it's fine. And it's just a disregarded entity for tax purposes, so there's no extra anything when it comes to the tax filings. Now, if your asset base is above a certain amount, you have to file Form 5500. So some people are not aware of that. But typically your IRA administrator will take care of that for you as part of their services. So IRA owns an LLC. LLC opens a bank account. IRA funds the bank account, and then it goes out and buys real estate and does whatever it does. Here's the thing you got to keep in mind for IRAs is that, and any kind of retirement plan, is that you cannot self-deal. Okay, meaning you cannot benefit. You can't put your brother-in-law in there. You can't put your parents. You can't put your kids. So you can't accrue any personal benefit from the investment. It has to be pure arm's length third-party transactions. So if you're I've seen people do flips in an IRA, which is fine. There's no self-benefit portion there. But if you're doing a rental property where you're holding the property long-term and renting it out, you just got to make sure that you are not getting any personal benefit from it. So if you just put it on the open market, random person rents it from you, great, no problem. If your brother-in-law says, "Hey, you have this house, can I stay there?" Don't do it.
Don't do it.
Now, there is this other thing that's related to this, and you'll see this promoted under different names called like Rob's setups and things like that, where basically the IRA owns the LLC or any kind of, it could be corporation also, either way. And then the LLC is doing something, and then the LLC hires you as an employee. And the guys who promote this say, well, if you follow certain guidelines, you can avoid the self-dealing issues and all this kind of stuff. It just makes me super uncomfortable, to be honest, just because that line is so blurry. So if you see that, just be very, very cautious. Make sure every I is getting dotted and every T is getting crossed, because if you are found in violation of those rules, the penalties are significant. So again, if you have money in the retirement account, self-directed, not self-directed, whatever, do not self-deal. That's the takeaway here. But as long as you don't self-deal, you can buy and sell almost anything, including real estate.
So no self-dealing, guys.
Yeah, that's if there's one thing to take away from that, that is the thing.
Okay, awesome. So it looks like we have a small business question.
Yep.
Someone wants to know, how do I properly set up an accountable plan to reimburse myself tax-free?
Well, you follow our guidelines.
That's true.
So an accountable plan, what it is this is a plan under Section 162-2 of the Treasury regulations. And basically, if you've ever worked at a job where like you went out to dinner and you wine and dine a client, and then you gave the receipt to your employer and they cut you a check, that's an accountable plan. It's a reimbursement of a personal spending that was used for business purposes. So if you run your own small business, you can also use this, but you got to make sure that, again, I's are dotted, T's are crossed. So what we've developed over time is a worksheet that has kind of the general categories that we see a lot of, and then we can always like fill in other categories as they come up, because the everybody's different, so it depends. But as far as things that are potentially deductible, home office type of stuff we use a lot. Now, home office people get confused because there's a home office form. What is it, 8824, 8829? One of those two. But that only applies to if you're filing a Schedule C. If you are an S corporation or a partnership or a C corporation, you don't have that form because it's not part of the same thing, right? Because those companies are filing their own tax returns. So the way to take those same kind of deductions is through an accountable plan. Say I have, this many square feet of my house is office space. And so I'm going to take that percentage compared to my total square footage and apply that towards, rent or insurance or utilities or what have you. So that's a common thing that we see. Travel, that kind of stuff. But there's a lot of nuance that goes into all these kinds of things. So the thing that gets people in home office deductions is the criteria is regular and exclusive. So regular is not hard to meet because I work in my home office 3 times a week or twice a month or once a quarter, whatever. It's regular. The exclusive is where people get tripped up. So it's got to be only used, and I do mean only, for business purposes. There's been all kinds of weird case law that puts this into stark relief. There was one case where a woman. This is actually my favorite one because it's so egregious. Woman has a baby. She's working from home. She puts the crib in the home office. And during examination, this gets revealed. It says, "Oh, well, you violated exclusivity, so it's not deductible." And it's just like, well, if you worked in a regular office and you brought in a crib, it's still an office, right? It doesn't change the character of that office. But in a home office, it does because just different rules. So you got to be really, really careful about defining your square footage. It could be just the square footage like around the physical desk. And that would still be worth doing because it also gets you to, it also allows you to start counting travel more than otherwise if you had no home office. And it's probably more complicated than we have time to go into right now. But yeah, so technically accountable plans do not have to be written in that you don't need a formal plan. However, we still do formal plans just because we just want everything written so that everybody's on the same page. And then, you have to, have the expense and then you have to reimburse yourself and you got to, manage that process. So I like to tie this into our Summit Strategy session where we have monthly management meetings reviewing your business. And you can do all those things at that meeting. So, and it's on the agenda, so we don't forget it, and we make sure that you take your reimbursements and all that kind of stuff. So, yeah, that's kind of like the generalities. I am going to be coming out with a standalone accountable plan, worksheet and video instruction, so that people can do their own accountable plans. But yeah, for now, that's kind of the general guidelines. And I think we have time for one more, probably.
Okay. So, well, I don't know if this it's gonna be an easy question or
Okay.
it might take a little bit, but it's not a tax planning question. What
Yeah.
are some simple ways to lower my taxable income of 100K?
Okay, so it depends.
Yes.
It depends a lot on the character of that income. If you're getting 100K as an employee, then as an employee they get you upfront, right? So under the Withholding Act of 1943, this was passed during World War II to pay for the war, and we're still dealing with it 80 years later. They take your money as you get paid, right? So it's you effectively you cannot get that money back. What you can do is you can do your contributions. You can contribute to a retirement plan, a 401k, a 403b, 457, that kind of stuff. You might be able, if you don't have those, you can contribute to an IRA, a traditional IRA. You might be able to contribute to a health savings account, HSA, if you have a high deductible health plan, which pretty much all of them are nowadays. That didn't used to be the case. So you can do that kind of stuff. If you have a day job and a side business, sometimes that side business can be leveraged against that day job income. but there are guidelines as far as how much you can achieve there. So yeah, you can talk about charitable deductions. You can talk about all these other kinds of things. So that's if you're an employee. If you are a small business person, whether you're a 1099 contractor or you have your own formal small business and have other people working for you, then the doors open much more widely, because again, the difference between an individual and a company is an individual gets taxed and then spends what's left. Company earns, spends, and then gets taxed on the remainder. Critical difference in order of steps there. So if you're on the company side, all kinds of things you can do. You can do accountable plans, you can do summit strategy sessions, you can look for different kinds of tax credits, you can do leverage spending. So every at the end of the year, I always see like these YouTube things of like, you should buy a plane because the tax deductions, right? It's like, well, yeah, that does actually work. If you buy a business asset like that and you're using financing to acquire the thing, you still get to write off the whole value of the thing. Again, caveats with all that kind of stuff, but effectively by leveraging finance, you're able to capture a tax deduction that you didn't have to spend that equivalent amount of cash for. So all kinds of stuff comes in there. But yeah, so I don't want to say sky's the limit when you're on the business side earning that 100K, but you have a much higher degree of flexibility when it comes to reducing that taxable impact on that 100 grand. So that is a large part of what we do.
Right.
So that's a good question. All right, we got a couple minutes left, so I just want to go into what's next. Next thing is, if you're not already, you should become an explorer. It's a free group, and you just go to taxsherpa.com/explorer, use the QR code, and then you get access to a bunch of stuff. You're going to get access to new products and courses and worksheets and things that we put out. So like the non-passive real estate investor, that's a free resource, free course that I put in last week. And you can even submit questions to these kind of streams. And you'll be the first to know about all of our stuff. So that is the next thing to do. And I hope to see everybody there. So we do this every week on Tuesdays at 6 p.m. Eastern. So that's where I am, Eastern. And so next time will be on the 18th of February. And I hope to see everybody then. And we will see what the next week brings, because obviously the news cycle is pretty fast these days. And we'll keep you up to date on any kind of tax or business type legislation, as well as get into all your questions and everything, and tell you all the different ways that it depends. So it sounds like a cop out, but I really mean it. It does depend on your particular situation, your facts, circumstances, and part of what I hope to do throughout all these streams and everything is to kind of showcase like how it depends and why it depends on different things. So it's always a new set of questions every week, and I never know what's coming, which makes it fun for me. So, all right. Anything else to add there?
Join the Navigators group.
So the Navigators is the step up from the Explorers, where
yeah,
where we have private weekly calls and all this kind of stuff. So that's the paid offer. If you want next level kind of stuff and access to everything that we do, then join the Navigators. But for the freebies, just go for the Explorers. You get a good 70%, and you'll get a really good bang for your buck there. All right. With that, we will see you next week, and yeah, do it.